Welcome to Real Talk, Real Advice and Real Difference. I'm your host, Nathan Najib, and in this podcast we bring you conversations from leading experts with experience, stories and advice to help you become a better person, a better agent, and help the community and the industry for the better.
Today, it's an absolute pleasure to bring to you Kelvin Davidson, Senior Research Analyst, Property Economist from CoreLogic. Kelvin is an expert in economic trends in both the residential and commercial property market. CoreLogic is the biggest platform I believe that agents and agencies use to look at property information and do appraisals. Kelvin, I appreciate your time. Thank you very much for coming along to have a chat with us.
That's a pleasure. Always happy to chat about the property market.
Who better talk to about real estate market than yourself? It's interesting time for us here in all around the world, obviously, and here in New Zealand. And for the last few weeks, my conversation with my clients, friends, and families have been around. Tell me what the market is going to do, Nathan. Now, I thought initially when it was end of March when we went into lockdown, I thought there would be two scenarios that can come out of this. One of them would be we go on lockdown and come out of it quick, and that won't hopefully damage the real estate market that much because obviously we can get the blood through the human body, if you will, if we talk about the economy that way, and get everything going back again. Like it looks like this time around, hopefully we don't get too complacent, and we don't go back into lockdown. And the other scenario I thought was if we stayed on lockdown for a long period of time, and that would have had a huge damage on real estate market. What's your thoughts about this pandemic, and how do you feel about those two scenarios, Kelvin?
Yeah, I mean, obviously the pandemic we're in is not going to be great for the economy, and lots of forecasts now that GDP this year will, across the country as a whole, will fall by 7 to 8%, which will be a pretty deep recession, and unemployment could rise to about 10 or 11%. So from current levels of about 4%. So we are looking at a deep fall in GDP and quite a sharp rise in unemployment. An unemployment rate of that level would put it back the same. The last time we saw an unemployment rate this high would be in the early 1990s, around the time of the mother of all budgets. So that really sort of troubled time for the New Zealand economy. So yeah, we're talking about a pretty bad economic outlook, but we should be looking at some sort of recovery that's relatively quick. This lockdown, okay, it will have knocked out some businesses, but most businesses have been sitting there waiting to get going again. So, once they're going again, as they pretty much will have been able to from today onwards to some degree, we should see activity come back pretty sharply. And most forecasts are that, the recession will be reasonably deep this year, but we can sort of have that V-shaped bounce going to next year. Now, it might take a while to get back to where we were pre-coronavirus, but the recovery should be relatively good, and unemployment coming back down again next year. And of course, we've just had the budget about a couple of hours ago, which has announced an extra about 15 or 16 billion of spending for the economy, and that will just help lessen that recession even further. So, we can't deny that it's a negative outlook, but also there's, it's not all doom and gloom either.
The positive that we got going for it is obviously the lowest historical low interest rates, obviously the multiple stimulus that was introduced by the government, and the mortgage holiday period. I would think that would make a huge difference in properties not going into forced sales, because forced sales is what makes the property prices drop.
Yeah. Forced sales leading into this recession were almost zero. Mm-hmm. You can pretty much say they were zero. And so we were at least starting from a pretty low base. And like you say, interest rates are as low as they've ever been, and potentially going even lower. There's a lot of support from the banks in terms of switching interest only, mortgage payment deferrals, extending the term of loans. So the banks are really in this and really looking to support borrowers. Of course, it's in nobody's interest to have a forced sale either. Borrower loses, bank loses. So I think all of those factors will sort of insulate the market. We can't deny that unemployment is going to rise, and that could create problems, but at least there are supports there. And of course, the government's announced an extension to the wage subsidy today, so just keeps that support going for a bit longer. As I say, we can't deny that there's a recession going on, and a higher unemployment rate will cause some people to reassess their finances, and we could see some sales coming through from that. I suspect more on the investor side than owner-occupiers, because of course owner-occupiers still have to live somewhere. An investor might look to get rid of one or two properties, maybe to shore up perhaps their finances in another business, or just to consolidate their position. So there could be some sales coming through from that investor side, but of course that creates opportunities for other investors and perhaps people with more cash looking around for those opportunities. So yeah, there are some supports, there's some negatives, but we'll just have to see how they play out.
With the LVR loosening up as well, that will have an effect of investors coming back to the market, obviously, and first home buyers be able to borrow more money, and as well as second home buyers can get into investments.
Yeah, that's right. The LVR rules for investors were actually pretty tight. Only 5% of lending could go out at less than a 30% deposit. So basically, as an investor, if you didn't have 30%, it was very, very difficult to get that mortgage.
Sure.
So now that those speed limits have been put on hold for at least a year, that will allow some investors to get back in who otherwise wouldn't have been able to. So that again, that's another support for the market. I mean, we hear it quite a bit from the banks themselves that this isn't going to be a free-for-all. There's still going to be a lot of testing of income in particular, and that the bank needs to be confident that people will still have a job in 3 or 6 months' time before they'll advance their loan. So there's still going to be tight testing around that. And even though the Reserve Bank isn't mandating LVR rules, it's possible the banks will stick to reasonably tight rules of their own. But yeah, we can't deny that it will bring some more investors in, and first home buyers who perhaps had that 10% deposit who couldn't quite get up to that 20. Well, they might have an opportunity now. So yeah, again, there's positives and negatives, and I think we just have to sort of wait and see how it plays out.
Yeah, well, the LVR restrictions came in when the property market was growing double digits. So it did its job. It slowed the market down, and now to jumpstart the market, it makes total sense to loosen the LVR.
Yeah, that's right for sure. We've been trying to get that message out there that there's been a little bit of commentary about how the loan to value ratio rules were actually sort of the worst thing that happened to the property market ever, and all these sorts of things. At CoreLogic and myself personally, I don't think that's the case at all. I thought they've done their job, and they've actually put the property market now on a much more stable footing than it might otherwise have been. They've kept some of that risky lending down, and so it means that we can go into this recession actually with a pretty stable market with lots of people having lots of equity in their homes. But as you say, now, so it's done its job. Now perhaps is the time to loosen them off and provide a bit more support to the market, as the Reserve Bank's done with lots of other measures too, around quantitative easing and cuts to the official cash rate, the extension of those bank capital requirements. So there's a lot of things that they're doing, and so now it does seem to be the right time to support the mortgage market and the economy in general. And the government talks about how there's no point letting businesses fail who are otherwise solvent, other than this sort of factor that's out of their control. So and in particular, around tax bills, that sort of thing, having businesses fail just because they couldn't stump up a tax bill seems a bit crazy. So some measures around that are really good, and it gets measures from the government, measures from the Reserve Bank, gets the economy through this hump and gets borrowers through the hump, and hopefully we can emerge pretty good on the other side.
Fingers crossed, and it's looking pretty good, and the government is doing great work. And like you said, the the government is in their best interest to keep the businesses afloat because they pay the taxes, and the taxes go back, pay for infrastructure and pay for the health of our country. And like you said, a healthy market, real estate market, is a growth between 1% to 4%, like the growth that we were having prior to the LVR coming in. That wasn't sustainable. So that's why we are that where we are now is not going to hurt too much, because like you said, the LVR, the loan to value ratio for most people are not, they haven't borrowed too much. Yeah,
and that's like you say, the double-digit rates of house price growth. They can go on for a while depending on credit conditions, and we've heard about people tapping the bank and mum and dad and finding all these ways into the market, partnering up with friends, all these things. But in the end, house prices are driven by what people can afford to pay and what their incomes are, and so double-digit growth in house prices over the long run simply isn't sustainable, because incomes don't grow that fast.
correct.
And that's really eventually the growth has to peter out to let incomes catch up and let affordability improve. The one thing that has allowed that sort of measure or that ratio to rise over time has been low interest rates. So even though you might borrow a lot in relation to your income, because of super low mortgage rates, it's been affordable for most people. So, and I guess leading into this crisis, there was a little bit of talk, perhaps, that interest rates over the longer term might actually start to increase a little bit, and that was raising questions about, well, is this affordable? So these mortgages are only being sustained by super low mortgage rates. What happens if they actually start to rise now? A whole generation of borrowers who have never seen rising mortgage rates, how does that affect their psychology? But we can kick those sort of factors down the road, because mortgage rates are going to be low for a fair old while yet.
Yeah. Like they said, if an interest rate goes up by 1%, expenses go up by 10%. So it is, you're right, like, if we haven't experienced a higher mortgage rate and you borrowed so much, now you can afford it. And if the interest rate goes up 4 to 5%, this becomes unaffordable pretty quickly. And you see, like you said, what goes up comes down. If double digits keep on growing year on year, it's just a matter of time for it to fall down, and that is a dangerous thing for the real estate economy. Tell me, you talked about the U-shape recovery and V-shape recovery off camera. Tell us a little bit more about that.
Yeah, well, I think I heard another economist call it alphabet soup. The shape of this, what this recovery might be. People talking about sort of L-shaped and V and U. I mean, it's all about the speed of growth and or the level of GDP. So how long it takes you to get back to where you were before, and even flipped up the other way for unemployment rate, how long it takes you to get back down from that peak. And so it's all about the shape of how things move. And we saw during, say, the GFC, quite a U or a bathtub, people like to talk about it, where the level of GDP and the growth rate collapsed pretty quickly, and then sort of bumbled along the bottom for a long time as governments sort of assessed what was going on, and as the banks themselves actually had to figure themselves out. Because remember that the GFC was all about, it was a sort of banking crisis, it was a finance crisis, which makes it very different from this time around. The banks now are playing a positive role, and they're actually still looking to lend, where there's back then it was different. That they had no choice but to sort of withdraw. And I was in the UK at the time, and banks there being seriously bailed out because of previously pretty shaky lending practices. It was much stronger here, and we've got a much safer banking sector here. But so it took a long time for that economy to bounce off the bottom, or the sort of bottom of the U, and start to rise again. Whereas now we haven't had that. There's not those sort of structural factors, structural problems there. I mean, I know the government's having to borrow more to do its spending, but generally we're on a much more stable footing, and so that's where the V comes in, where once people get out of lockdown and can get back to business, recovery should come through pretty quickly. And there's some sort of belief, and I think that will probably be seen to a degree in the property market as well. There's been pent up demand through lockdown, people wanting to still transact and just haven't been able to because of the bans on sales that involve physical movements of people. So there's still people wanting to trade, and we hear a lot about how that demand's now coming out, investors keen to buy. And think about people who have been locked down for a month, maybe their house, their kids are everywhere, and I think, gee, I wouldn't mind a bigger property or a property with an office or a study. At the same time, perhaps people are thinking, well, this might be my opportunity to kind of leave the labour force, maybe at the end of their working careers, and downsize. So there's still a lot of that activity to come through, and people are always trading. So there has to be I think there's a reasonably good chance that over the next month or two there'll be some decent activity.
I predicted, I thought, because there's still a little bit of uncertainty, even though we come out of the lockdown and we're looking pretty good as a country, we're doing really good. Even then there's a little bit of uncertainty, and I think once we go to level 2 and hopefully level 1 and we're back to normal, as normal as it can get, then there's going to be obviously demand, and as you say, it's supply and demand, right? So there's going to be influx of buyers, in my opinion.
Yeah, I think there will be, at least temporarily, as that pent-up demand comes through. And of course, the other side of it is that we went into lockdown with listings very low, all-time lows for the stock of property available on the market. So there's not much choice for people, and with that active demand coming through, I think actually the near-term outlook for prices need not necessarily be that negative, actually, with a tight supply of property and a reasonable amount of demand. The question for me comes, let's say by the time you've got to the end of the year and unemployment's risen a bit, some of these government supports are wearing off, and we are starting to see maybe people thinking, gee, I might have to drop my asking price here. That's where we could start to see some pressures coming through. But and I think for the year as a whole, we will see sales volumes down. I don't think there's too much sort of doubt about that. We will see volumes lower this year than they were last year, and I think there is clearly downside risks to prices, but forecasts out there of let's say a 15 to 20% fall in prices, I think for me are too negative. I think there's reasons why it'll be better than that, including what I've already said about the banks. Very different this time for the banks than the GFC. They're playing an active role this time. We've got some housing shortages. Affordability actually is better on the measures we look at than it was leading into the GFC, and super low mortgage rates. So I don't think we'll escape price falls altogether, but I think 15 or 20% is too negative.
Sure. And there's two types of crises. You've got man-made crisis, which is like the GFC and the banks lending money. That's why that happened. And then you got the natural crisis. Like this is probably bordering to like the earthquake, pretty close to earthquake. I thought, Kelvin, because we have had the earthquake here in Christchurch, and I think it's probably more like an earthquake than a man-made crisis, right?
Yeah, I suppose it's a little bit sort of halfway house, isn't it? It's a little bit hard to find clear precedents. We've had like the SARS outbreak, but it was much limited and much sort of shorter. And we've had clearly big recessions in the past related to budget tight governments, and we've had obviously the earthquake issues in Christchurch. So there's all these different episodes, and none are quite the same. But I think in terms of the outcomes, I think we're going to be much more likely to be closer to an earthquake scenario where it's a sort of short, sharp shock, and then you can get that recovery. And so nationally, house prices fell about 10% during the GFC. Right. I think we're any downturn this time, it won't be larger than that, I don't think, for those factors that I've just mentioned. In Christchurch specifically, during the GFC, prices were down about 10 or 11% as well, so it's pretty similar to the national average. During the earthquakes, prices fell very temporarily and sort of 1 or 2% just immediately around that earthquake period, and then just took off. Not hard to find reasons why. There was a shortage of properties. We lost however many 5,000 or 7,000 properties out of the red zone. So prices took off thereafter. So I think we are probably closer to the scale of impact in terms of the earthquake rather than the GFC, even if the causes are not quite the same.
Well, the affordability, in my opinion, in this time around, the affordability, because you've got interest rate lowest ever, that's really going to help. And the only reason the prices come back because there's so many forced sales. People need to sell their homes less than what they're worth prior to the lockdown. And like we discussed before, likelihood of that, too many forced sales, I'm sure there'll be a few, unfortunately, because people would lose both their jobs perhaps, and they need to offload their property for whatever they can get for it. But I don't think, I thought, Kelvin, if this thing was extended for a long period of time, probably maybe another couple of months in the lockdown, we might have seen 5 to 7% decline in the real estate market. But now I see, especially here in Christchurch, because that's what I specialize in Christchurch, I don't see any drop in value, in my opinion. I think there will be an influx of buyers in probably 4 or 6 weeks, and then the market will kind of stable itself, in my opinion.
Yeah, there's I think this recovery, both nationally and in Christchurch, there's sort of phases. I think we will see a 2 or 3 month phase where that pent up demand's coming through and offset against, or goes up against, tight supply of listings, and so you do get a reasonably good looking market for a while. I think you'll start to see sort of sentiment and the real hard indicators change later in the year as those unemployment rates rise. But yeah, particularly in Christchurch, there's some downsides for sure. International tourism's a pretty big part of Christchurch's economy, and that's clearly going to be gone for a while. And that flows through into the sort of hospitality sector, particularly in the central city that was already struggling a little bit. So there are some downsides for Christchurch. But we run some affordability measures, and basically housing in Christchurch is more affordable than it's been for at least 20 years, and it's more affordable than the rest of the country as well. So we run, one of the measures we look at is the percentage of the average household income that is required to service a new mortgage, basically. So assuming a fixed interest rate of 3% and a 20% deposit, what that mortgage payment would be as a percentage of income. At the moment in Christchurch, that's about 25%. Long-term average for that figure is more like 32. So currently 25, long-term average 32. So it's already quite a long way below average. The national figure currently is 33. So Christchurch is a pretty long way below the national average. Auckland, for example, is 38. So, Christchurch is not only looking more affordable than it has been historically compared with its own history, but also compared to a lot of other parts of the country. So that's a pretty important support. I think we may look back in 5 or 10 years and say, gee, Christchurch was the one that outperformed. It was pretty clear it was going to outperform, wasn't it? Because look how affordable it was. I think for the next 2 or 3 years, though, there is this issue of housing supply. There's been a lot of new houses built, especially around Selwyn and Waimak. So I think we tend to think more about Christchurch now as Greater Christchurch, and our stats have shown quite a decent flow of people selling in the city. Maybe people who bought their first home in the city are now thinking, okay, I need that second home. What do I do? Do I buy an older established home in Christchurch City, or do I buy a new build in Rolleston? And there has been a flow of people doing that. So really the supply is probably needs to think about Greater Christchurch, and that's still growing. There's still a lot of building consents out in Selwyn, and so I think for a year or two that supply will keep a lid on prices from that sort of fundamental perspective. But yeah, longer term, Christchurch definitely looks affordable, and we may look back on it as an opportunity, and it's certainly what I hear anecdotally from some investors. Yields, of course, are better in Christchurch and other parts of the country as well.
We've had investors like this year, from start of this year, we've had more investors come in looking at properties here because, as you said, it's so affordable here in Christchurch and yields are better. The 5 variables that drive the real estate market, you just touched on average home price, the supply of inventory, the sales, annual sales, and fluctuation and affordability. You talk about affordability, Kelvin, and affordability is the amount of household income and the percentage of that paid towards a mortgage. And I believe anything under 30% is very affordable, isn't it?
Yeah, well, that is a bit of a benchmark, yeah, for sure. And nationally, we're currently sitting at 33, as I said. So, housing is a little bit less affordable than maybe it would be ideally, but it's hard to. Affordability it's kind of a relative thing. It's hard to really say that's affordable, that's not, because it's a very judgment thing and depends on a whole lot of measures. But what we certainly can say is that Christchurch's affordability, it's all relative. It looks better than that or that, and it certainly looks better than the national picture, and it looks better than it has historically. So that is a support. But yeah, I mean, in terms of some of those other measures you talked about, Christchurch has definitely had a tight supply of listings. It's a sort of more stable market than other parts of the country. I mean, we saw in Auckland, sort of leading up through 2015 and 16, or just after 2016, actually, quite a big rise in listings, and then they have started to come back down again. That's total listings on the market. Christchurch tends to be a bit steadier, but even it has seen a decline in listings over the last sort of 6 to 12 months. And based on our figures, we've got sort of about 4,000 on the market in Christchurch, or sort of wider Canterbury, I guess, at the moment, down from about 5,000 a year ago. So it has been sort of a 20% dip in listings around sort of the greater region. So it's pretty tight, and that's a trend that's the same elsewhere across the country.
It's interesting though, because there's so many developments going around all around the city. You drive out 20 minutes outside the city, there's subdivisions going in. So you would think there'll be more stock on the market. I'm assuming that's still to come to the market. Yeah.
Well, and I guess what it does, so as those new builds are finished, they'll obviously, I mean, some of them will become listings. There's some people will be building their own home and moving in, but of course that leaves behind a listing somewhere else if they're an existing owner occupier. So yeah, that will add to the stock, and I guess going forward, for real estate agents, I guess a bigger mix of what's sold or what's on your books and Christchurch and Canterbury will be new builds. And so I guess thinking about sort of marketing strategies for those will be important. But yeah, that and we have seen, well, I don't have appraisal figures for Christchurch specifically, but we saw on our platforms appraisals generated fell about 80% during lockdown. So it was a pretty big fall, not surprising. Yeah, there's some anecdotes and feedback I get that some people have been surprised not surprised that it fell that much, but maybe surprised that there wasn't a bit more activity, because you'd think during lockdown is a good time to, work on your business and contact some old clients and, generate some more of those CMAs or appraisals to get yourself set up for the rebound afterwards. So, but yeah, it fell sort of 80% during lockdown. What we've seen in the last couple of weeks is a pretty sharp rebound in appraisals, actually. We're currently running now about 10 to 15% below pre-lockdown levels. So it still hasn't fully recovered, but the rebound's been sharp. And, for prospective sellers, it's probably just going to take a bit longer. They want to get out of lockdown first and figure out what the heck they're going to do, and before they choose to get that appraisal and move through to listings. So appraisals have picked up a lot, and we've actually seen new listings rise quite a lot too. It was a very weak period for new listings during lockdown. It looked a lot like Christmas, actually. You seasonally see new listings fall to nothing during Christmas as people go away and lawyers are off and everybody's off. And actually, during lockdown, it looked a lot like that. It was kind of a second Christmas period, but new listings have rebounded a lot since then. And so there's definitely activity in the pipeline that will lead through to mortgage applications and valuations ordered by the banks and get through to agreed sales. So yeah, like we've been talking about, there's definitely activity in the pipeline.
You said the appraisals dropped by 80% during a lockdown, and I thought that would be the number because they dropped down. In Australia, the number was, I think, was 60%. So 80% here because we couldn't do anything. Australia, they could still do viewings and things, right? So 80% sound pretty fair to me. And like you said, uncertainty, when people come out of lockdown, like we have, it takes a couple of 2 weeks to get our minds around selling our homes, perhaps. And our conversation with our clients have just been touching base, see how you guys are and what we can do for you. And it is obviously in uncertain times, human behavior, we tend to freeze and do nothing.
Yeah, and there's a lot of uncertainty at the moment. There'll be people wondering about whether their job's sustainable. Is it only propped up at the moment by the wage subsidies? Is their business going to survive on the other side? And it's not really the time where you'd necessarily be confident about making that big property decision. And that's why I do sort of wonder whether the activity we will see, at least on the sales and listings side, is going to be more balanced towards those investors as people look to shore up their portfolios. But as we've also talked about, there's people who want to, I know personally from some people I've spoken to, that they're like, wow, gee, my house is too small. We don't have enough space. We're definitely trading up. And so that sort of activity will become more common, as well as first home buyers still keen to get in, and those sort of savvy investors. So yeah, there's definitely activity coming through, and we'll just have to see how strong it is.
Yeah, I think it will take probably 2 to 4 weeks for people to get their heads around, and hopefully we don't have to go back on another lockdown. Then we can hopefully just crack on.
Yeah, that's. I mean, I don't sort of run these numbers or anything, but a lot of the bank economists and people who are really paid to nut out these figures they're all saying that would be the worst of all worlds, that we decline back into alert level 3 and certainly alert level 4. That would just be a catastrophe. So it is all about holding on to the gains, and that's where the government, for me, has really done a great job to make sure we just proceed cautiously, because proceeding cautiously might involve a few job losses and some businesses continuing to struggle on. But I think the view from economists that it would be much worse if we proceeded a bit more recklessly and had to go backwards. So
well, the reality is, health is the most important thing. If you haven't got the health, if we hadn't this under control, the economy would have suffered anyway, as well as we would have lost way more lives. So that would have been a dangerous situation we would have been in. But now, like you said, we did go in sharp and short into lockdown, but it has been short though, 4 or 5 weeks, and we're out of it. And hopefully, if the numbers get tracked down and we don't get too complacent, as I said, then we'll be out of the other end quicker, like a V-shaped recovery, like you said. Hey, tell me, I know you touched on this before, Kelvin, but the difference between the crisis that we've had, like GFC and the pandemic, what would be the difference you would point out?
Well, as I said, it's hard to make direct comparisons because each thing's got different drivers, and I guess different scales of government intervention. It's the intervention this time's been really quick and significant, and throwing the kitchen sink at it. So it is a bit different, but yeah, I guess, I mean, in terms of, say, real estate activity in Christchurch pre-GFC, there was sort of running at about sort of 1,300 sales a month sometimes for Christchurch. So pretty busy market. During the GFC, well, that was pre-GFC, about 1,300. At the worst of that crisis, it fell away to about 400. So there was a big drop. You saw sales fall by about sort of 1,000 a month on average. So pretty big drop. Fell even lower during the worst of that earthquake period. We're down to sort of 250, 300. Right. So, but that was short and sharp, and quick recovery thereafter. So sales figures are it takes a while to get them through the system, but just prior to lockdown, Christchurch was running at about 600 sales a month. So still high, still much higher than the earthquake period, still much higher than the GFC, although only about half as much as they were pre-GFC. So still quieter than then, but a decent, solid market. And that's a trend that we've seen across the country as a whole, that just in general, turnover rates have just trended down. And I think that's probably people's debts are higher, and the costs of moving are increasing all the time. And I think probably just there is that long run trend over time for people to move a bit less frequently and trade property a bit less frequently. So yeah, Christchurch is not any different than lots of other parts of the country where sales volumes are sort of looking like the new norm is lower than it was pre-GFC.
Okay, and obviously with coming more supplies to the market, and that would obviously having more supplies, and that's what happens every time, as you can appreciate, Kelvin. Like when there's demand of the properties, developers go and acquire land, and by the time they go for the consents and they start developing these properties, that buyer rush has already gone out of the market. So that was what slows the market down. Supply, obviously, it's always supply and demand.
Yeah. It's the old thing of lags in the system, and the construction sector. You ramp up, but it takes a long time to actually build the properties and get through that pipeline of work. And in the meantime, demand's fallen away, and that's how you get. It's the old boom and bust cycle in construction, which unfortunately is pretty hard to avoid. And I guess we're slightly running the risk of that at the moment. I don't think it's a huge risk, because we know there's this huge underlying need for property in the country, and building consents have been running very, very strong. We're in one of there's been 3 really massive building booms in the country over the last 50 odd years. So it's sort of the mid 70s. When was the last one? Sort of the early 2000s, and now. And so we're currently in one of the 3 biggest booms for building consents that we've ever seen. So it does suggest, and that's great for the construction industry short term. There's a lot of work to come, even after they reopen now, and so they got to work through those previous consents. But there is a risk, I think, that in the meantime, just that demand falls away a little bit, and some of those homes do need to be, so the price needs to be looked at a little bit. But yeah, there's still a good amount of underlying demand, and people still need extra homes. So there's I think the outlook is okay for construction. Yeah.
So tell me, in the real estate market, you should. We discussed like 4 weeks time, probably there's going to be influx of buyers. So if you're thinking about selling, you go to the market and get your property prepared and go to the market, or ideal situation. I call it an early spring, Kelvin. Like, in spring is a time like, buyers are out there, but I believe this would be probably mid-June. In June would be an early spring and winter, a buyer's rush, don't you think?
Yeah, well, it's interesting, the seasonality. I mean, that's another factor potentially, sort of keeping listings down in the near term, is that we are going into winter, and so traditionally we do see that winter lull in listings. This time, obviously, there's different circumstances, so maybe that normal seasonality doesn't quite apply, and we see either a rise in listings or at least a smaller fall than we normally would. But it's interesting. We sometimes get asked, what's the best time to sell? And all we can do is look at the stats. And actually, there's very little evidence that achieved selling prices are any lower in winter than they are in summer or spring. It looks like all year round is a good time to sell.
Yeah.
And I think what people forget is that, okay, there might be fewer buyers in the market in a normal winter because it's cold and they don't want to go out, but there's also fewer sellers. So, as a seller, you've got less competition for that pool of buyers. And so the evidence on seasonality and house prices is actually pretty low in terms of selling prices, and any time and to some degree is a good time to sell. But this year could be different, and we might actually see a decent level of buyer demand even in winter because of that pent-up activity that couldn't take place in April.
So if you were thinking to sell later in the year, perhaps you can bring it forward slightly, and that will be in your advantage, in my opinion. Tell me, Kelvin, what's your thoughts obviously the numbers of sale, that's inevitable. That will shrink. There'll be number of buyers going to be making the same. That will shrink as well. If you were an agent, what would your thoughts be? What would you be doing right at this time?
Oof, tough question. I think, yeah, like you say, I would. I think the risks to the market as a whole are more weighted towards the end of the year. I mean, I'm saying this as an economist thinking about trying to be a real estate agent. It's an interesting thought experiment. But yeah, I think the risks to the wider market are later in the year from that economic perspective. And so if you were looking to push through appraisals and get some listings on board and get those sales done, it may well be that sellers themselves are going to be better served doing that sooner rather than later, because some of those economic pressures might not have fully emerged yet. It may be that they don't become fully apparent till later in the year, and that's where buyers might be a little more cautious, whereas in the meantime perhaps they've still got their job and are willing to pay the same prices. So yeah, I mean, I'd be looking to, I suppose it's always the case, you're looking to push through as much activity as soon as you can, but I think that's probably even more important right now.
You be proactive when you get on the phone, obviously, like you just said, and get on the phone, talk to your clients, obviously say, hey, this is probably next 4-6 weeks would be a good time to go to market. And that's the reality. We just been talking about this. There's going to be a rush of buyers, and when there's an influx of buyers, then if your property is one of 5 rather than one of 500, then obviously you achieve a better price for it. That's just a supply and demand thing, isn't it? Now, just before I let you go, how do you predict if you're going to say for the rest of the year, how would it unfold? What would you say? What would it look like in economy perspective and real estate?
Yeah, I think we've probably covered a lot of the things. I guess bringing it together in one place is probably 2 phases. We've got, from the economic point of view, we've got this phase where the government's ramping up support. There's wage subsidies, so businesses are continuing on largely. We've got also this sort of pent-up demand that's now going to come through for people to go to their local restaurant or jump on a plane. So those sorts of things could prop up activity for a little while. There is going to be a big drop. Don't get me wrong. International tourism's not here anymore, and so there is going to be a drop. But there might be a little bit of a honeymoon period, and then you get through to the end of the year, and from that economy point of view, the unemployment rate's rising, and some of these support schemes are wearing off, and so yeah, sort of 2 phases where maybe not too bad for a start, and then starting to look a little bit weaker, and that will be mirrored in the property market too. I think with listings still tight and some of that pent up demand coming through, could be a reasonable market for a little while. It might be some time until we see the real clear evidence of falling sales volumes and potentially prices coming through. But once you get to the end of the year, that looks a bit more likely. But as I said earlier, some of these predictions for prices to fall 15 and 20% to me look a little bit too negative, just for some of those reasons. We've got super low mortgage rates. We've got supportive banks stepping in with all these supportive measures. So yeah, probably 2 phases, and things looking a bit weaker by the end of the year.
Yeah, and it's all dependent on, as we discussed before, and we discussed most of these things, but as we talked about, as long as we don't go back to lockdown, we can come out of this quite nicely, in my opinion, a lot better than what the prediction has been. Even myself, personally, I thought if we went out for long-term lockdown or long-term economy, that would hurt the economy very badly. But looks like as long as we take care of, be good and not get too complacent, hopefully we'll come out nicely.
Yeah, that's right, and it is sort of each of our response. We're all responsible for that. I mean, there is no denying that to get the economy through in the near term, the government's had to borrow a lot more. So, and that will, over the long run, that will hold things back, because They're going to have to pay that back somehow, and one possibility, and one probably pretty strong possibility, is that we'll all face higher taxes in some shape or form. So that will limit the sort of potential growth rate that we can have in the economy over the long term. So it's sort of, we're taking a bit from the future to sort of keep going now. So it is, the long run outlook is a bit weaker than it would have otherwise been. And as I said, it may take a little bit to get back to previous levels of activities. And we can't ignore the possibility of future tax rises. But I suppose that's the price to pay for staying okay now.
That's exactly right. Now, you've covered everything I want to talk about. I really appreciate you, and it's been I know it's been a lot of help. A lot of people, as I said, we've been almost every conversation that I have with friends, families, clients, they want to know what's happening with the real estate market, and we thought we had to get Kelvin in so we can clarify as much as we can. Thank you very much for your time.
No worries, all good. Hope it was useful.
It was really good. Thank you very much for that. We'll catch up with you again, I'm sure.
All good. Take care.
Thank you. Bye-bye. Bye.